Hi, I'm Ben Mohr, and I cover fixed income at Marquette. This is the Investing 101 video, the bonds section. In this episode of Investing 101, we will cover what a bond is, the categories of bonds, and common terms for bonds. At the most basic level, a bond is a loan, and that could be a loan to a government, a company, or a group of people. We invest in bonds mostly to receive regular interest income. However, bonds may have some appreciation or depreciation in price, but over time, most of a bond's return comes from its interest income. When an investor invests in a bond, the funds go towards the bond issuer. Issuers may be sovereign like the U.S. government, municipal like the state of Illinois, corporate like Boeing, the airplane manufacturer, or a pool of mortgages, each of which would have a homeowner paying monthly mortgage payments. The bond investor receives regular interest income payments, and when the bond matures, the investor receives the original principal back. Bonds exist along a risk-return spectrum and typically have lower risk and lower return than the equity asset classes. This chart shows that core bonds have the lowest risk and return. Next up are bank loans, followed by high-yield bonds, capped off by emerging markets debt, which has higher risk and return than high-yield bonds, but typically lower risk and return than U.S. large-cap stocks over time. Besides investing in U.S. bonds, investors are encouraged to complement their U.S. bond holdings with non-U.S. bonds. The benefits of non-U.S. bonds, which include both the emerging markets debt and global bonds asset classes, are risk and return drivers from non-U.S. interest rates, credit fundamentals, and currencies. The left box here breaks out the three key emerging markets debt segments. Hard currency sovereign bonds represent bonds issued by emerging markets countries, such as Brazil. The hard currency means that these bonds are denominated in US dollars. Local currency sovereign bonds are also issued by emerging markets countries, and the only difference here is that the local currency means that these bonds are denominated in the local currency, such as the Brazilian real if it is a Brazilian bond. Finally, hard currency corporate bonds means exactly that. These are issued by corporations based in emerging countries, and these bonds are US dollar denominated. The box on the right breaks out the segments within global bonds. It includes US bonds, non-US developed market bonds, such as those issued by Germany or Mercedes-Benz, a company based in Germany, and emerging markets debt. Global bond investment strategies may be hedged back to the US dollar for US investors, or they may be left unhedged. Some important concepts to bond investing are the spread, the yield, the duration, and the maturity. We'll cover spread and yield here and finish with duration and maturity in the following final slide. Simply put, bond yield is the bond's return to an investor. The chart on the right shows the high and low ranges of yield for each of the major bond asset classes over the last 10 to 20 years. As you can see, there can be wide variations in the yield provided, even within a single asset class. We can see, for example, that bank loans are currently yielding 7%, slightly lower than their long-term average of 7.9%. The left chart looks similar, but it profiles spreads instead. A spread is the difference between the bond yield over its base rate. In most cases, the base rate is the yield on a treasury bond of comparable maturity. In the case of the high yield spread of 391 basis points today, that 391 is added to a comparable maturity treasury yield to get to the 6.4% yield shown on the yield chart on the right. Bank loans are a special case where their base rate is LIBOR. So bank loans spread of 467 basis points shown on the left would be added to LIBOR to get to the 7% bank loan yield on the right. Duration and maturity are the last of the key bond concepts we'll cover in this video. Maturity is the simpler of the two. Maturity is simply the time from now until when the bond fully pays back its principal. In other words, if a bond is issued today and will pay back its principal 10 years from now, then the maturity on that bond is 10 years. A year from now, it would take 9 more years for that bond to pay back its principal, and its maturity at that time would therefore be 9 years. Duration is a bit more involved, but important nonetheless. The key point with duration and how we as investors use duration is that duration is a bond's price sensitivity to changes in interest rates. In other words, duration is very useful in that it tells us the expected change in the price of a bond due to interest rate changes. The example here could help explain. Say we have a bond that has a duration of 7.2 years. Its price change to interest rate change will always have an inverse relationship. That is, if interest rates decrease by 1% or 100 basis points, the bond's price will increase by 7.2%. Conversely, if interest rates increase by 1%, again 100 basis points, the bond's price will decrease by 7.2%. To summarize, a bond's maturity is simply the time until the principal is received, and duration is simply a measure of a bond's interest rate sensitivity. Thank you for viewing this episode of Marquette's Investing 101, the Bonds section. We hope that this was informative, and if you have any questions, please don't hesitate to contact any of Marquette's consultants or research team.